In early 2026, we gathered a panel of leading experts in the field of shareholder disputes at the office of Laytons ETL. The panel comprised Barrister Paul Mitchell KC from 4 New Square, forensic accountant Daniel Djanogly and tax expert Jamie Muirhead from Wilder Coe, and myself, Geraint Thomas, the head of disputes at Laytons ETL, with my litigation partner and regulatory expert, Ben Thorogood. Episode 4, Valuations and Relief. Daniel and perhaps Jamie on this, in an ideal world, what do you want to see? What should we be asking the clients for? What do we look out for? So, should we deal with those in reverse order?
Yeah, absolutely.
Typically I'd be thinking, well, you want to see all the accounts, of course, and
not all necessarily all the accounts. If the remit is one about valuation at a valuation date, we need to know the valuation date required. Could be the current date, could be a past date. Then we kind of work from that starting point, the valuation date, whichever one it is, or it could be a combination, as I say. And we're interested, for valuation purposes, you're interested in the position as at the valuation date, as to the future prospects, earning prospects of the entity. To start with, as a principle. So you'd gather in financial information to give you that. So you're not looking for the accounts necessarily that show the performance 10 years ago, but you are looking for, say, 3 to 5 years worth of accounts, management accounts since the last statutory accounting periods to the date of the valuation, if necessary. You'll be looking for to get using the valuation data as the information cut-off point. You'll be looking for projections, business plans, forecasts that exist as at the valuation date.
A lot of these companies are going to be private companies, so and particularly the young ones, the publicly available information is going to be limited. So presumably, you are wanting to really dig into full accounts.
So when I'm talking about accounts in this context, I'm not talking about filed accounts at Companies House. I'm talking about the full statutory shareholders' accounts. Notes from the director's report through to the profit and loss account, through to detailed trading accounts, and then the notes that go with it. So it's for the statutory shareholder accounts that would be issued. Where we're talking about the period from the last set of statutory, or I'm calling them statutory accounts, full shareholder accounts, to the date of valuation, the management accounts won't necessarily be in the same format, but we all have to work with what we've got. And in some cases, you may need to go down to the level of trial balance to see what's in there. Sometimes you might even call for the VAT returns. If it's possible to get, and it makes sense to do so, and it's proportional to do so, you would seek to fill in the information gap as to the financial performance up to the valuation date and beyond in the ways I've just described. But that's just the accounting information. That's like your starting point from which to then derive a view on financial prospects, the financial situation as at the valuation date, because there's a host of other valuation points to take into account. Private companies will have an ability as to choosing what to pay them, what the directors will be paying themselves. There may be family members engaged in the business, not doing very much for the business. What you want, as we drop down into the more technical side of the valuation, to get to your main what we might call, if it's an earnings, going to end up being an earnings valuation or an asset valuation, because they're classically the two references for this sort of exercise. You'll be looking to go a deeper dive into the financials as to establish and the arm's length open market rates of expenses that are being incurred for on the payroll side, on a variety of different services. And
so
that might be
you're talking about bank account information, zero.
No, that's right down there in the detail. We're talking about management accounting information, information.
So maybe not as deep as that.
Maybe not as deep as that, but the inquiry will need to be made as to those income and expense items that are not in the ordinary course of arm's length open markets business.
Yeah. Do you think? I was going to ask. Do you think making tax digital, the MTD program will have an impact on the questions that you ask?
So making tax digital for income tax is coming in 6th of April this year. There was proposals for corporation tax to come in, which have a similar effect, that it would move forward the reporting date. And as I understand it, the proposals were that they would report quarterly. So that might mean that the management accounts or management information that Daniel was talking about would be a little bit more formalised, even where it's before statutory accounts were prepared. But the income tax proposals were delayed by a number of years before they came in. And the corporation tax ones, we don't have a revised date for when it's going to be implemented. So the answer to your question is possibly, but not for a while.
But the expectation is for most people in the sector that it is going to happen.
Expectations are mixed as to whether it's going to be implemented in due course or whether it's been kicked into the long grass. It's a watch this space, I think.
Yeah.
But just to follow on from Daniel's points in terms of the tax, I think there's two areas where it's really relevant and important to consider it early and fairly carefully. Number one is inputting into the valuation, because whether it's an earnings-based or whether it's an asset-based valuation, making sure that any either crystallised or uncrystallised liabilities is a fundamental part of the valuation. And one of the quite big risk areas, because the amounts can be quite big and it's quite technical and could quite easily not be identified, is tax. So taking a really simple example, if you've got property held in the company, if it's gone up in value, then they might not have recognised what's called deferred tax in the accounts, but whether that's often a negotiating point between the parties to the valuation as to whether it would be reasonable for that uncrystallised tax liability to be shown in a valuation. And similarly, if there's groups involved, the way that the reliefs could be relieved between them or have been relieved between them is quite commonly the subject matter of unfair prejudice claims if there's minority interest in slightly different proportions in groups.
Yeah.
If reliefs, either group relief or some of the interest restriction matters, have been relieved and it's to the detriment of a minority interest, that could be the source of the claim in the first place, perhaps. And then the second point is to do with, possibly to do with the quantum, but thinking ahead to motivations of the parties and possibly what a resolution might look like. The structuring from a tax perspective could be as big as, if not more than, the quantum that you might be arguing about between the parties, and it's important to have that information early on so that can inform, we're arguing about whatever the quantum is, the potential tax exposure is more, should we talk about that first? Because, and I'm sure we'll get into the different types of remedy and different types of interests that you might have in due course, but potentially some of those restructuring or payouts might be subject to income tax at up to 45%, which is a pretty substantial proportion of the proceeds that one or other party might be getting. Or even if nobody's getting a physical cash payout, having a dry tax charge as part of that is going to be a really kind of a cash flow issue that needs to be considered fairly early on.
Yeah. So these are key considerations that are often ignored.
Yeah.
Or at least
thought of until not as early as maybe they should.
I mean, we've all been involved in matters, I'm sure, where there's suddenly a light bulb moment where an expert is brought in, a la Daniel, who says, "Have you thought about tax?"
And in terms of coming back on the shopping list point. It's a lot of ground to cover in the valuations. I have probably indicated this sufficiently on that point. But if you just looked at earnings-based valuation and focused on something called the enterprise value, you'd miss out the rest, because if we're talking about the valuation of shares, then you're looking at surplus, what might be referred to as surplus assets and liabilities. And in that general category, you're looking at, say, for example, if the entity that you're valuing has a freehold, is not a hotel, but has a freehold interest, this premises are held on a freehold basis, you would be potentially, depending on the circumstances, as I say, substituting arm's length commercial rental charge for the notion, so to speak, of the premises and its charge to the business from a buyer perspective, and then adding the value of the property to the value for the business.
It's really interesting you say that, because some of the professional practices that Ben acts for typically have just that scenario, have the freehold property from which the professional practice operates, and it's possibly the most important part.
And with the value of the property would be potentially the contingent tax liability. You'd have to allow for the contingency, the probability aspects of contingency, without going into too much detail now.
Yeah.
But these are considerations that are beyond, so to speak, simply an earnings-based valuation.
Yeah.
But the same, just by the way, goes, for example, in respect of directors' remuneration, where they haven't been, the directors, and certainly in the early stage company scenarios, you might have accounts that don't show an arm's length open market directors or management charge, simply because they set themselves up to avoid the burden of that. But at a certain point, looking forwards, that historic trend in charge for senior management isn't the true reflection of the actual management involvement and charge on an open market basis. So you'd have to make an adjustment to take out what has been paid and put in what the market, so to speak, what the market charge might be. So this is information you'd have to get, the range of information. So in addition to the accounting financial information, you may, depending on what's there, you may need to get in property valuations, you may need to, as at the valuation date, you may need to get tax expert inputs on the contingent tax position, information about what in the management commitment in terms of time and cost ordinarily would be on an open market basis, and there may be other adjustments
with
like
the management charge.
Yes, to adjust for in the valuation to get to your arm's length valuation. But all this though starts with I mentioned the valuation dates or dates. Associated with that is the valuation. Let's call it the valuation. The applicable valuation assumptions, the fundamental assumptions for the exercise, which is on the willing buyer, willing seller, open market, going concern basis of the entity, which can be a group, of course. And that in itself can throw up issues that need to be explored. That is particularly on the going concern side, because the entity may have financial difficulties, and you need to allow for that, because it doesn't come out simply, the valuation doesn't simply come out from an earnings valuation, because when you look at the balance sheet, you have a different outcome, and you have to adjust for that.
And as you're working through the sort of valuation aspects, obviously you've got the routine adjustments that you've identified. So if individuals are either taking salaries at below market rate or above market rate, but in terms of how do you keep an eye on other wider anomalies and that type of thing that may affect valuation?
So are you talking maybe about there may be expenses going through which are not business?
Yeah, indeed.
There's sort of non-business expense.
Or if there's a more systemic problem that isn't just sort of...
We're verging into a fraud discussion.
Well, indeed, but there's you're exposed to a lot of data, and I'm curious to see how you can, or to what extent you apply your sort of investigative...
Sceptical eye to start with. Right, so it depends on what you see, what's there and what you see. Yes, the more the valuer with some experience will see something potentially that a newbie might not. But when we say what we're, when we talk in those terms, it's an anomaly in trend. Usually, anomaly in trend. It doesn't make sense that particular line of expenditure has shot up in relation to something else, maybe turnover, without an explanation. There's something funny about it. Is it an exceptional charge that was genuinely incurred, or is it something that has got a deceit aspect to it?
And now when we have more sophisticated tools, rather than do you use sort of not only your critical eye manually, but are you able to feed this sort of data into generative AI? And
we haven't had to yet. When you say feed data into AI, what we have to think about what data we're talking about. If we're just talking about what's in the accounts, i.e., and by which reference, I think for this discussion we're talking about the published accounts to shareholders. That's not going to be the data. The data is going to be drilling down into the figures that have gone into the account. So I mentioned the trial balance, or you have the nominal ledger sitting behind the trial balance. So you have all the data sitting in the books and records. And I've done many exercises where you can spend endless amounts of time working with that data, summarising it, showing the trends. And that itself may throw up anomalies. I mean, there may be the way the particular transaction deep below in the ledger is recorded, that the descriptive may look a bit odd for what it is, and it might be there's something there that's an AI or some sort of.
Yeah, I think that's it, because there's various areas in which this can sometimes bear fruit, and where we have a world that's creating more and more data and documents, and it can throw up things like, are these genuine invoices or what?
So that's a very important. So we have what we'll have is the accounting ledger, the old style ledger book you open, has a line entry for the transaction. That string of data might itself, as I was just touching on, might suggest something that looks a bit odd. You have to get to it though, to look at the page before you would know this. But you'd open the page, just run your eye down. It looks at that. What's that mean? But that's not the end of the story. That's just like the start of that inquiry on that particular transaction. Because ultimately, you'll have to go down to the underlying documentation that supports. It's a kind of audit. If you come from an audit background, you're looking for the underlying. You're looking for the audit trail in document terms. So it starts as an odd entry. You essentially ask for the supporting invoice, purchase order, correspondence around, and then you'd evaluate.
We find it's not always the exceptional item that is the problem. It's the cumulative effect of something that's much less obvious.
I'd like to make an observation about, because one thing is looking at accounts and discovering anomalies which indicate fraud. And another thing, which is related but slightly different, is looking at matters of fact which might come to pass in the future, which might affect the value. So, I mean, if you're looking from the perspective of the minority shareholder, I mean, most of the time there is something on the horizon which someone will say is either going to wreck the company or make it rich. It depends whose side you're on. And that's a hypothesis. And I think one of the things that lawyers do in the value added of lawyers in this kind of dispute is making the case for the hypothesis which your client is advancing. So if you're the minority shareholder that says, look, if you do go into business with Jack, we'll lose everything. Alternatively, if you follow this line, we'll all get rich. And your job is obviously not to make decisions about what will or won't happen. It's to use the facts in front of you, which you're told to assume are true or not, and then price them up. And I think that this partnership, I mean, when you're an independent expert, obviously it's not a partnership in the strict sense because your duty is to the court. But there is an element of partnership in that you're asking questions and we've got instructions from the client, and between us we're sort of working out what evidence is required to put a fact before an expert to give a valuation, which then comes back to the lawyers who start the negotiation process. And I think that this this kind of iterative process which goes on with taking instructions, clarifying what evidence is required, obtaining the evidence, feeding it into the experts, is one of the reasons that these unfair prejudice petitions can be quite expensive. Because if you're thinking about all the other strands of litigation which are also going on. But it also it illustrates the value of making choices on areas to fight about early,
But you may not know
Well, of
early.
course, that's the point. Sometimes you don't know at all.
And you
where
may
the
not
fraud point
know,
comes in.
interestingly, whether it's going to be an argument for the lawyers or an argument for the accountants.
yeah. Agreed, yeah.
I mean, I was just looking again at section 996, which sets out the remedy, and if the court is satisfied that a petition under this part is well founded, it may make such order as it thinks fit for giving relief in respect of the matters complained of. That couldn't be any less concise.
Yeah.
It is really. It is the court has unlimited power in this area to grant a remedy. So
It does.
we have to work, don't we, between ourselves to ensure that whatever remedy, if we're in the realm of having to craft the remedy, if we're the aggrieved party, acting for the aggrieved party, we have to work together to ensure that the remedy that is being sought is the remedy that the client actually needs.
Yes. No, I see that. I mean, sure, and our role as the expert side is to inform inform the decision maker.
Yeah.
So the client ultimately, via their lawyer, using us in our area of expertise.
And then ultimately helping the judge, because the judge needs to know how to exercise their power and discretion to achieve the right outcome. And we are helping. I mean, and it is. These are instances where we are, because it's so ill-defined, we are having to work together, as I say, to craft the remedy.
And could you paint a bit of a picture for me in that scenario? In your experience, has often the remedy been a financial one, where one disadvantaged party is actually exiting the business for a financial payment?
I think that is a typical scenario.
Yeah.
That's not to say that there aren't others.
Yeah.
Although the sort of statutory relief is very wide,
Yeah.
these things tend to play out in a way with a sort of order that the prejudiced party have their interests brought out.
Yeah.
I think the exercise of the wide discretion tends to be applied in terms of what adjustments need to be made within that context. So putting funds back in, unwinding certain transactions, and applying different metrics in terms of the valuation date, perhaps if for example, the steps were taken that just before something that is objectively increases the value, the sort of wide range of discretion, I think, is applied more in terms of what adjustments within the context of a purchase.
And so in terms of tools at disposal then to come to an agreement in the centre, in a lot of purchase and M&A type transactions, the type of tools might be something like an earn-out or something akin to a future performance-based metric. Do you ever see that very often, that if two parties say, I think we're going to do this in 2 years' time, and the other party says, I think I'm going to do half that, are coming together and saying, well, we'll see what happens, and the payout will be contingent upon future
I think that's a fascinating question, because in short, the answer is no. If you're looking for a judge to determine it for you on a particular date, i.e., when they hand down their judgment at the end of a trial.
Yeah.
But if you're looking to settle through a mediation or some other dispute mechanism, then the world is your oyster in terms of the remedies that might be available. And, it might be to both parties' advantage to have some kind of earn-out where, they don't lose out too much, because if the event happens, but the paying party, if it doesn't happen, doesn't have to pay for it. So, they both get the upside, both take the risk of downside. So that might be that really shows the value to me of mediation. And
so I've seen a few.
It does. That's a real advantage of having the matter resolved between the parties as opposed by the court.
Yeah.
But I think why sometimes those types of things don't happen in practice is because, one, they're very difficult to define when the settlement's taking place, but equally they're prone to give rise to further disputes down the line about what
Future
the actual
results.
arrangement was. So, although that type of thing works quite well in principle, in practice, and I think we see it less frequently.
Interesting. Yeah, I haven't seen one where it was a performance-based kind of equity return over the years, but what I have seen fairly commonly where there's funding or cash flow issues for the company is that there's some kind of disposal of the interest and maybe some kind of right of action and information over the company. But there's an understanding that the exit consideration is loaned to the relevant party, possibly at a rate of interest. And that's got quite a few interesting and important tax issues. So taking a really simple example where we've got a singleton company and maybe there's two shareholders and one of the shareholders is exiting, and for ease of thinking about it, let's say that they're exiting all of it on day one and they're completely leaving the company. If the company has enough funds to fund that exit, in some respects, maybe that's slightly more straightforward. They can, if they've got different shareholdings, have a think about their tax position, maybe where they're tax resident in terms of the different ways they could structure taking that payment out of the company. If they've got different categories of shares, maybe that could be a dividend depending on where they're tax resident. Probably if they're in the UK, that's not the best way of doing it. If they're in the UK, they might think about a purchase of own shares. It's a fairly common way of doing that. They'll buy the exiting shareholders' shares back. And then in the UK, they would normally want to think about whether they meet the conditions for that to be a capital a purchase of own shares. So you're thinking about things like pre-transaction clearance with HMRC. Do you meet the trading conditions, benefit of trade, no connection after the exit, various others, some anti-avoidance rules as well, important to flag.
I think something in terms of resolving things at the man stage. Actually, if people have applied their minds when they entered into the arrangement in a slightly more rigorous way than having a boilerplate resolution clause, that can focus the minds quite well, because we've seen things from the boilerplate to the extremely unusual the dispute to be determined by race around the world, and because that's so unrealistic in terms of in practice, are they going to race around the world in these contained sort of restricted ways, or are they going to say no, that will destroy our respective interests in this business? And so I think applying where there are some constraints to resolving it is if parties have applied their mind early on to how they deal with an issue.
Yeah, and it can also be a really important driver, actually, to facilitate some kind of action and decision. I mean, you mentioned earlier that if the minority interest is not very keen on exiting, sometimes it's quite difficult to get buy-in to agree a fair price so that all the parties can go their separate ways. Now, if it's, in your example earlier, if it's a minority who's maybe not involved in the business anymore as much as they were going to, they might have been thinking they'd be entitled to a beneficial tax treatment when they get exit consideration at whatever price they see fit. Possibly they qualify for business asset disposal relief, and that's
entrepreneurs relief or something like that.
As it was, entrepreneurs relief. Yeah, so now 14% rather than 24%, up to £1 million. If they're exiting the business and maybe not being as involved as they were before, is there a time limit on whether they're entitled to that relief? And that might set the parameters for any future negotiation. It depends how involved they are in the business and the particular facts. But that can be a motivating factor at the beginning, as well as something to consider when you're looking at setting the criteria for the exit and for the structure.
Yeah.